Here we go, Raleigh.
Hey, hey, hey. Hello, everybody. Good morning, and welcome to this week's edition of the Roundtable with your man, Don Yocham. Don, I know you got a bunch on the agenda today, and I can't wait to hear what you're going to be talking about and the guests that you got lined up for us today.
Yeah, we got a great lineup, Raleigh. Thank you for all that. We got Celeste, Garrett, Roger. It's going to be awesome. We're going to talk about, of course, we can't avoid the debt ceiling debate.
I know.
Whether or not recession is here, those are things, but we got a lot of other kind of more in-depth topics, a lot of specific things that we're going to talk about. This debt ceiling debate, I don't want to presume too much. I assume that most people have the opinion that they're going to get it solved, right? I mean, default is not the way that governments end up getting rid of their obligations. They inflate it away, right? That has ever and for always been the realm of sovereigns, right? The easiest path, the most politically feasible path. So,
right.
Not raising the debt ceiling would be a huge outlier in the full scope of history. So, but anyway, we're going to talk about that right now. I don't want to go too far into it. I'd love to ask Roger, Celeste, Garrett, why don't you guys join, hop on, and we'll get rolling.
Hey, Don, how are you?
Roger, great. How you doing?
Doing
like that
well. Shirt.
Nice. Is that a polo?
It is.
I haven't seen one of those in a long time, man. They still look good.
Thank
you. So we got Roger and Celeste.
Hey, how are you doing?
Hey, Celeste. Hey, Garrett.
Celeste.
How are you? Good morning.
All right. Okay. Hey, and we got Garrett. Hey, Garrett, what's going on, man?
I'm caught in the middle. I'm in the middle of a squeeze on Luminar Technology, so I'm just kind of like setting my position and saying, all right, I'm going to be talking for the next half hour. I need to make sure that I set a stop.
We'll talk around you right now, or about you.
No, we're good.
Not to you. You let us know when you. Hey, so Celeste, Roger, why don't we kick off? Okay, so the debt ceiling debate. Evidently, Biden can go off to Japan now because all the lower level functionaries are going to chat among themselves how to solve this debt ceiling. And that's kind of making the market feel a little bit better. I don't know. The only outcome most people, come up with is, it'll get solved. But I don't know. How are you handicapping this? Celeste, why don't you go first?
Okay, well, I think when we were talking about, using different strategies, approaching the summer, all the different things that come at us with the debt ceiling, inflation, whatever we're fighting, having those creative ways, looking at short term, looking at longer term, and just keep doing what we're doing. Just keep doing what we're doing. Keep trading. Don't put your head in the sand, but stay active. Those are some of the things, broadly speaking, that I'm doing. I don't know how.
Gotcha. It'll pass. I'll take that's kind of what I read from what your comments there.
Yeah.
Great. Roger, what are you seeing?
Well, I think I try to stay away from politics and mix them with the markets because I've never found that I think it just adds another piece of complexity. In this case, I think it's going to be the same song and dance. I think it's going to be the last minute nonsense where nobody's agreeing on anything and then it's all going to get done. It may be a day or two late, but I don't see the scenario that's going to happen like when we had the last time we had a scenario was this like this when the X date was approaching, and the X date right now is June 1st. The last time we had a scenario like that, I believe it was during the Obama administration. If I am correct in thinking that. I am, right? It was during
no, absolutely. Yep.
Yeah, it was during the Obama administration.
I think there were two threats. 2011 was the big one.
2011.
It was either 2013 or 15, I think there was.
2011 is the one that I'm thinking about, Don. And if I'm correct, the market dipped. The market dipped about 20% during that period on the anticipation that it may not get done. I'm not really seeing that. So here's my take on it, and I'll be pretty brief here. I think the market has withstood so much crap in the last 3 to 4 years, starting with COVID, maybe even before COVID. I mean, Trump administration, COVID, we've just had one fiasco over the other. Global economy taking a big dump. I think if you look at volatility and if you look at what you've heard the saying, the VIX is broken now. The VIX is broken now. I don't believe it's broken, but I believe that it's been desensitized because of all the things that we have seen.
That's a good point. That's a really good point, right? I mean, it's taken so many punches. It's tough now. It's hard. And that's what you kind of arguing, right? It's not going to react to any little thing.
Well, like, let me give you a good example. Like and I'm really bad with dates, like going back, because I have so many data markers in my head with markets. I just don't have a date. But if you remember when we had two major events happen, one was Brexit, and one was the default of
Greece.
Greece. Thank you. I guess it's a little too early still for me here, but when we had those events, one of those or both of those events had a huge fluctuation in the VIX. The VIX spiked like it was no tomorrow. Matter of fact, one of those two fluctuations was the biggest movement in the VIX in history. I remember that because I had a program that involved the medium-term ETF, which was ZIV, and that ETN went out of business effectively on one of I don't remember which one, but it was one of those two occurrences. But think about those occurrences and think about that in relationship to anything we've been through in the last couple of years. It's like not even worth talking about, right? Brexit compared to COVID. I mean, you can. So I think I think the market has seen so much stress. And I mean, the volatility on the Dow was 695 points a day for a year, okay, on average, not 250, 695. So when you see things like that, and when you start looking at things in perspective, I just don't think, I think the market has become a lot more resilient to nonsense, at least over the last couple of years. And I think it's going to take a long time for for that desensitization to go away. And how does that all relate to the debt ceiling? I think if this was a normal market, and I think if we didn't go through COVID and all of those other things, I think the market would react very differently and would be a lot more volatile and would be pricing in a lot more of that downside in comparison to what we're seeing right now.
Yeah, no, those are all good points. I think the one that they are playing a little bit with fire, more so in the past, in that Jeffrey sent this article to me the other day, this kind of analysis. What is very different now about the prior debt ceiling debates is that so much actual treasury is used as collateral in margin, right there. Before it was, like a lot of mortgage backs, government guaranteed, those kinds of bonds, and now it's really concentrated in treasuries, and those are all posted at clearing houses, and they back treasury futures, all the futures markets, everything like that. And for those to get shaken is a massive event. But and PIMCO warned of this morning. Short-term yields could go up to 10%. That kind of panic in the actual guts, right? The very plumbing of the global financial system could definitely. It'll either what it'll do is it'll motivate Congress and the president. But it could be a rough before that. Yes, sir.
Let me just highlight three things, and then I want to hear what Garrett has to say. But I want to highlight this. In 2013, the Treasury Department found that 2011 debt ceiling standoff cost a $2.4 trillion decline in household wealth. And keep in mind, we have 4.2 million full-time employees working for the government and 60 million people receiving monthly Social Security checks. So there's a lot to this. I mean, this can really go bad. Sorry, I didn't mean to cut off your flow,
hey,
but I wanted to give you these.
Dole, right?
I thought those numbers were pretty important.
No, they are.
They are important. They are important. And if you look at the Treasury numbers yesterday, we spent $57 billion yesterday, largely on interest. That's the revenue annually of, I believe, Pepsi, which is insane to even consider. So you've got, let's just point something out real quick, right? So right when Yellen comes out a week ago and says we have to raise the debt ceiling, she immediately says we have to start cutting Social Security. Then the administration says we need to cut firefighters and water safety people. Like, they always make it as painful as possible. Like, let us keep borrowing money or your parks are going to burn. Your water might not be safe. And like, that's insane.
Grandma's going to go hungry.
But grandma's going to eat cat food. And the reality is we have 2.5 times the revenue to pay for Social Security and all this stuff. Really, at the end of the day, It's prioritization. And I look at it and I think it's a joke. I don't believe that the X date is June 1st. I think it's actually probably somewhere out to like September. This is all a bluff. But if you look at the long-term picture here, the idea that they're going to try to do this without any level of negotiation or conversation about the spending. I did some analysis the other day because I wanted to put this into perspective. So people were asking, what if we went back to the 1950s? Those tax levels, right? That was the highest one of 90%. Like that would close the budget. And the reality is in the 50s, that never got to that level. Nobody paid taxes. 10,000 households did. And in fact, it was so prominent that people engaged in a lot of schemes involving oil and collapsible corporations to drive down their taxes from 91% if they got to that level. If a person in that time made $200,000, that's about $1.6 million per year here. If they made that much money, that would be 90% at 1.6 million if we matched 1 for 1. So I did some analysis. Taylor Swift made $185 million last year. If that number was at the level where she was, you would be, she made $185 million. She would be paying that at that 90% level and above, $165 million $9 on every 10 to the government. You think she's going to work anymore? You think they're going to have Swiftonomics anymore? You think that there's going to be an economy around this stuff? It's nonsense. It is the spending. Focus on the spending, because otherwise we're going to 50 trillion and we're going to break Social Security within 10 years. And then all bets are off for the US dollar.
Well, the long term here, 100% is, and that's what I was saying in the open, right, is that they won't dial back the spending, right? And it doesn't matter if it's the Fed stimulating or the Treasury spending, right? It's more money, it's more spending, and that is ultimately inflationary, right? And that is how they're going to resolve the debt problem. That is how they've always resolved the debt problem. That is how they're going to resolve this debt problem. And it doesn't have to be, it's not necessarily going to be an orderly process, but there's any calamities that are going to be short-lived, or they're going to cut and run and ultimately just spend more, right? That's the only way out. And the Fed has nothing to do about that. They have nothing to say, right? And I think on that tax analysis, Garrett, that was really great. Historically, throughout all of America, no matter what, it's the Democrats or the Republicans or who says what about taxes, I believe the net effective tax rate is around 17 or 18%. It might be 20% or something like that. It barely budges around that level, no matter how much we argue about it, right? And that's about all. That's all they can squeeze out of the economy, right? Or otherwise, you get into these perverse incentive structures like you're talking about, which are absolutely ridiculous. And it's not. We can't. That won't happen. Okay, all right. Well, so that's the debt ceiling. That was great, guys. Some really good comments. Appreciate that. But then there's the recession, right? So everybody's handicapped in recession, and Garrett, you mentioned the Fed's as we were talking about topics. You mentioned the Fed's got a estimate, and it's as high as it's ever been since 1982, and it's always guaranteed. And of course, everybody's talking about recession now. Why don't you talk about that for just a little bit, and so we can put that out there too. And all of this is intertwined, right? So.
Yeah, this is just something that the New York Fed does. It's effectively the yield curve as an indicator, and it effectively provides a little bit of an assessment of what the odds are for a recession. It's currently at about 90. It's at 68% for the April of 2024. That's the highest since 1982, and as we know, 1982 was a pretty bad economic period. This estimate only got up to about 45% back in 2008. It got to 43% back in 2002. We remember those being pretty difficult economic times. I pay more attention to the Conference Board, which is a nonprofit with a lot of businesses, corporations, and businesses all around the globe. They have it at 99.9%, and they have been correct pretty much every time since they started analyzing this, going back, I believe, to 1916. So it shouldn't be any surprise. The one thing that I will say that is a little confounding, because I'll be writing about this today in Trading Pub. Remember back in November of last year, we did not see a recession in terms of economic numbers, but the bulk of the positive GDP number came from the selling of the Strategic Petroleum Reserve. It was the part of, think about GDP, business investment, government spending, consumer spending, exports minus imports. we were exporting the Strategic Petroleum Reserve and counting that to our GDP. Here's where it gets fun. Once we start buying oil from the Strategic Petroleum Reserve, possibly from U.S. producers, that counts as government spending. So that is cooking the GDP number on that side. So we can dump our oil and count it as GDP, and we can buy it back with taxpayer money and count that as economic growth. That is fantastic economics.
There is some violation of double entry bookkeeping going on there for sure, man. No doubt. Hey, Celeste, before we roll into some of the things that you wanted to talk about today, with recession, what are you seeing, and how's that kind of work into what you're playing with?
Well, I always love listening to what you all have to say. And that was a wealth of knowledge there, Garrett. Thanks for that. So to me, I guess it comes down to, there's really only two sectors, right? I mean, there's the government and there's everybody else. Mm-hmm. So it's like, we have to respond, because what I'm hearing too, as I listen to the conversation, is that, again, it's like, they feed us certain headlines. There are things that they want us to hear. There are things that they probably don't want us to hear. And we have to figure out how we play within that. And really, it's just like the best thing I can do is I close my ears a lot to it and just have to look and like trade with my eyes. So recession, yeah, I mean, it seems to me the stats are that we are in, or we're definitely going to be in. And then so how do we respond to that? Where are the opportunities? And that's what I always try to keep my focus on. That I love.
So you're seeing some. So you're seeing, as far as that goes, right? So I think I talked about this on maybe Ask the Pros, right? But I kind of see the sideways action through the summer for the S&P, and then a rally into the fall. But right now we're still in this chop, although there's definitely some buys out there, and I'm starting to retail sales, the consumer is hanging in there, right? And I wrote about this yesterday. Paul McCulley, one of the guys that I worked for at PIMCO, used to say, when you're always handicapping recessions, and he said, never underestimate the hedonism of the American consumer, right? They will always spend, right? And that's that's kind of keeping it in, and that can drive those stock prices higher, right? That's a sign of some bullishness. You're starting to see some outperformance on the small cap side, and a lot of people say that when small caps turn, that's kind of signals the near term, the bottom is approaching. Well, what are you seeing there, and what are some of the sectors?
Yeah, absolutely. Is it okay if I take over the screen?
Please, yes.
Okay, let me do this here. 1, 2. What I was noticing is, y'all know I look at research a lot, and one of the things that popped out to me was this slide that I'm showing you right now. This is from Bespoke, and it talks about the year-to-date performance on the sectors. We all know large caps. We all know tech is really just blowing it out of the water. But it was really, really interesting. What really caught my eye is this part down here at the bottom right. Are these sectors where what this red is saying is that the small caps are actually outperforming the large caps in these particular sectors year to date. And so that just caught my eye, because yeah, you're right. I mean, when you see us start to come out of a recession, you start to see those small caps starting to do that. And we think, well, how can that be? Interest rates are rising. That's usually really painful for them. But if I take this factual information and I dig a little deeper, it's kind of interesting. So what I noticed was, particularly healthcare, materials, consumer staples, industrials. And then, so let me show you some things I found. So I did some research on that. Let me put that down. Some sectors like, okay, well, how can we as retail traders easily kind of find out, well, what are some of these stocks that we're talking about that are small caps? How can we find them? And I came across this SPSM ETF. I can't say that I've traded it or know a lot about it, but it was a small cap ETF, 600 the small cap stocks. And what's cool, this is on Thinkorswim, if you can see that all the way to the left. And I'm sorry, that print I know is very small. In fact, I'm gonna put my big glasses on here so I can see it all. But what's really cool is that you can kind of here on the left side, you can scroll through these different industries. If you look at this, the ETF itself, it does not look good. It's not a pretty chart at all. But what's cool is you can click on the different sectors like healthcare or industrials, and it'll automatically populate with what those small cap stocks are. And from there, you can start to go and look at the charts of those. So like I noticed one of them was uncategorized was that Elf. Remember that? We've talked about Elf, a cosmetic line that some people have really liked. Well, that's a powerful stock. And you can just start to populate those on that right side. I've got those stocks populating, but just kind of going through that is a really interesting thing to do. And my point is like, maybe some of these are trading up, are good trades. Maybe they aren't, but starting to open your mind to the opportunities. Like there's Fix. I don't know what Fix is, but maybe I want to start to understand what some of these stocks are. So going through, you can just kind of go through them yourself and pop them onto your favorite screen. So that's something that I found. Another thing that I found as I was looking at that, because, I like Roger, I love seasonal analysis, and that's really kind of, saved my bacon over the years, even in bear markets, believe it or not. But this XHS is a healthcare service ETF, and it doesn't have a really beautiful chart pattern. However, what's interesting I found about that is that it is compared to the XLV sector, the healthcare sector. This healthcare sector is up for the year. And so it shows a little bit of promise. And again, you can go and you can dive into that one. I think this one also showed, if I put this into Think or Swim XLS, that it will also, nope, not that one. XHS, excuse me. XHS. See if that populates. Yeah. So this one also shows the different stocks there. And so you can kind of just start to get an idea. And again, the idea is to have your mind open to, if we are going to have these turns, you should start to see them in there, because if this is a stock picker's market and a new way to trade in the summer, then having your eye on some of these is really helpful. So, but what I noticed on that seasonal trade is that XHS has shown up on my scans as seasonally strong here throughout the summer, as well as another one, Zoetis. Are you familiar with Zoetis?
I've heard the name, but don't know anything about them.
Zoetis, it is an animal healthcare place. It's like the largest one. And it is, now this is a large cap though, but it's just another one that has seasonally shown strength for the next 10 days, 20 days, 30 days. So something to kind of keep your eye on. That's so kind of seasonally, that's what I see. One other interesting thing I was going to show you is on, let me come back to this PowerPoint here. Go to a big screen.
What's the Zoetis ticker? I can't remember. Is it, what is that?
ZTS.
ZTS.
Zebra Tom.
Animal health. A lot of focus on not just your pets, but also agricultural animals.
Oh, interesting. Yeah.
Hmm.
So there we go. The other thing that's interesting, and I think, and this plays also to a lot of what you have said, Don, in that 4,200 level, which I've always kept my eye on. But this is just a chart from Thinkorswim on the S&P futures. And you can see I'm on the right side of that screen. You got that kind of that 4,200 level that you've been talking about. You can see how often really we have been bumping up against that, and even now. But one thing that's interesting too is if you and I'm sorry that print is small, I know, but those lines are everything about the Fed. It's like even when Jerome Powell got COVID, I've got that marked on here, how the market responded to that. But these Fed dates, the FOMC dates, you can actually kind of start to see a trend that develops around that day. And so right now, over here on the right of the screen, you can't necessarily see it, but that candle, that red candle marking that date, the candle wick goes up a little bit higher. And we are right now, we're still just fighting against that high on that FOMC day. So that high and the low of the FOMC day, that's just kind of a nice pivot point that I think that has helped me over the years kind of understand the trend kind of in between those. And so I just wanted to throw that out to everyone as well.
Thank you, Celeste. Thank you. Garrett, let's go to you right now. On the oil front. So IEA released some numbers. I'll tell you what, and I know everybody would appreciate some help here. Well, at least me, because I've given up on predicting energy. I mean, my God, my charts are useless. So what do you see?
Well, I think you have to focus on long-term supply and demand fundamentals and really focus on individual businesses right now and follow the people who know the businesses better than you do. And the best way to do that is just simply dig into what the insiders are telling us. So if I take a real quick look at this screen right here, this is SEC Form 4. These are SEC documents that are when executives at companies put their own money down or they are large insider buys. And we've consistently seen over the last couple of not just months, going all the way back to mid-year last year, every time OXY Occidental pulls back, it's hitting 58, 56 bucks. Buffett's buying it. So I've used that kind of as a proxy to sell put spreads around that specific line over and over and over again. And it's interesting to see this sell-off right now because you're clearly seeing a lot of concerns around recessionary issues. One of the other things, there's money that's kind of flowing from oil and food and everything that is a real asset into AI stocks because that's where the momentum is in the market. It doesn't change the fact that when we get into the second half of this year, we have low SPR. You had the Saudi Arabia came out yesterday and said we need $12 trillion in capital to produce oil over the next 10 years. That money's not there. It's not going to be there. So there's a supply and demand imbalance, not just within oil itself, but in the capital that is needed to procure that. So from a long-term perspective, it's a matter of just being, looking out 18 months, 24 months, thinking post-Fed pivot. You print a significant amount of dollars. Money is going to flow into the stuff that matters. Real assets matter. And while, yes, you should have a speculative part of your portfolio for AI, keep in mind, oil will revert on a dime, largely on supply and demand equilibrium. And once you start to see a little bit of capitulation out of the retail trade, sure enough, the institutional and the CTAs step right back in and buy it for less. And then we see that cycle start to repeat. So I just don't see a place where oil is down in the low 60s. I consistently tell people to buy and invest as if oil will remain around $75 per barrel. And you saw a name like Blackstone.
So you play exclusively the individual energy stocks, right? You're not trading crude oil or anything.
I don't trade the UCO. I don't like to mess around with futures too much. I mean, if you get into a backwardation situation like we're in right now, you can weigh on this. It's just not worth it to me. So if I look at the executives, I see Occidental, I see Energy Transfer, I see Callan, which is another name that's really popped up. We continue to say, even if oil is going to pull back, it'll be a big focus on high production wells. And if oil and natural gas really pulls back, I'm telling you, KKR and Crescent Energy are rubbing their hands together because they will be able to buy up every distressed driller that they could possibly get their hands on and turn those things into absolute cash flow machines in the next 5 to 10 years. And that's kind of the long-term perspective that I have with energy, more of a private equity mindset, higher focus on good wells, good businesses, good capital discipline, and looking at where the insiders are buying it and trading it around those levels as an entry point, if not even 20 to 20%, 15 to 20% lower. I'll gladly take it because Warren Buffett knows a lot more about oil than I ever will.
Awesome. And real quick before we turn it to Roger, and just to get pick a fight here. So you've got some regional bank stocks that you think look pretty good, and I know Roger's got some that you want to short. So let's hear it.
Well, I mean, I think you pick and choose some of this stuff, and you have to think about what your risk tolerance is. I look at a company like PacWest currently trading, down around 4.5, and we know for a fact that there really isn't anything significantly wrong with that bank. Their deposits, they had enough money, 180% of their deposits, cash just on hand. Yet you have this crazy situation in play where the shorts have been targeting, and that's very clear. So I had been trading down around that $2 put because I'm either going to make $1,000 or I'm going to make 50. I'm going to make 1,000. It's almost a coin flip to me on that. The dividends cut there. Fifth Third really is throwing me off. Like the way the Fifth Third has seen so much pressure. The average
FTFB, right? Is that the ticker?
FITB. So FITB, you look at that bank, their average relationship is 15 years, right? And it's very hard to shake things like that. They don't have commercial real estate issues. When they did their investor presentation during their earnings report, they basically came out and said, listen, we only have about $5 billion of exposure to to all of this nonsense. So yeah, they got a $5 billion loss on paper. But aside from that, everything looked clean, yet this got taken down with the rest of the regional space. So you're seeing a lot of insider buying again in a lot of smaller banks. East West Bancorp got some bids, Ameris Bancorp, Third Coast Bank shares. Even down around this level, though, we're seeing a lot of insider buying on names that are, SoFis of the world. And that's a signal to me. Like SoFi is a very questionable, kind of zombie type of environment to me. But if you look at SoFi, insiders are coming in and putting, hundreds of thousands of dollars on their own stock. CEO just bought $500,000 worth at 4.67. Are there still a lot of banks that have a lot of problems to them? Yes. And they're likely going to be the banks that are located on the West and the East Coast that are still might have a lot of ties to either cryptocurrency, digital asset management, or potentially something linked to, the early venture capital stages.
Awesome. Thank you, Garrett. Okay, Roger. Yeah. Let's you've got some things that you want to talk about on the regional bank side as well.
Yeah, I do. Just to comment, Garrett was talking about Warren Buffett and oil. Warren Buffett's 13F just came out a few days ago, and he increased his share of Oxy from 194 million to 212 million. And he decreased his holdings in Chevron from 163 to 132 million. So I thought that was kind of interesting. So he's liking his Oxy. He likes his Oxy. And I think that was Garrett's number one on that list that you had. I saw Oxy a few times on there as well. So
125 million.
Yeah. So let me go ahead and just share my screen if that's okay. So I think what's happening right now with the regional banks is we have a lot of negative sentiment. I mean, if you look at KRE right now, that's the ETF that tracks regional banks. I mean, it's not doing so well. A matter of fact, I was looking at regional banks. I couldn't make up my mind on which ones I didn't like better. So I shorted the whole thing, which is down right now. But the trend is still moving in the right direction. Now, in terms of the two regional banks that I really think are negative, it's East West Bank. Don't like East West Bank. I think their financials are not looking as good. And I think the stock is going to have more downside to go. And the same thing with PNFP, Pinnacle Financial Partners. They do a lot of escrows, a lot of mortgages. They're not looking as good. So I think we're going to see more downside. I would use these opportunities to sell these banks. I don't think they're bottoming out. I think there's more downside. Also, with the economy, anytime we see anything negative in the news, it's going to hit these banks first because right now they're in the doghouse as far as sentiment is concerned. So these two banks are my banks to sell right now. Now, aside from the regional banks, one of the things that I wanted to talk about is the QQQ. A lot of people are bullish on the QQQ simply because it's doing really well. I mean, look at the momentum levels. It just looks like it can't stop going higher. The problem is, and this is one of the things that I look at, I look under the hood, and when I look under the hood, I look at this. This is the equal weighted QQQ. This is the QQQ when you strip away all that stuff from it, like the FANG stock.
It's not market cap weighted. Yeah, so it's not like going to be four stocks determining the direction, right? It's
right.
Yeah.
Well, think about this. 5 stocks make up 37% of the market cap in the QQQ. So, yeah. But we know that those 5 stocks are not going to control the market. I mean, they could for a little bit, but they can't sustain that kind of pressure. Yeah. So if you look at the QQQ, it's really setting up in a symmetrical triangle, not in a breakout ascending triangle, which is happening because of NVIDIA. I mean, look at what NVIDIA is doing right now. It's going crazy. NVIDIA has a huge market cap. It's happening because of Apple. Look what these stocks are doing. It's happening because of Microsoft.
It's a leading AI chip maker. Yeah.
Yeah. So you have, I mean, if you look at the QQQ by itself, and if you look at the constituents in the QQQ, you will see, and I like how this breaks it down, Microsoft, Apple, Amazon, NVIDIA, these right here, I mean, you're talking about 37% of the index in these 4 or 5 stocks. And then you have Meta and Alphabet, and they're still doing pretty good. So I wouldn't be looking at the QQQ as a whole. More importantly, this is really important. When you look at momentum levels on the QQQ, you will see that we're only 50% of stocks in the QQQ are trading above the 50-day moving average. So if you're looking at and 20-day moving average, and even the 200-day, only 59. Visually, if you're looking at the QQQ at the chart, you would think by that time about 85% would be above, but no, only 59. And here it's only 50. And usually it's the leading starts here, not here. It goes down this way and it goes up this way. So if you look again at the QQQ, and if you put the 50-day moving average on it, which I'll do in a second here. Now, I did this yesterday for my guys, and you will notice that it starts looking very, very different. It looks like it should be down here, not at 328, at about 314, because that typically when you have 50% of the index trading above the 50-day moving average, that means 50% is below. You should be right down here. So I'm not seeing this. I'm not very convinced that this upside momentum is going to continue.
Right. Yeah. No, I definitely, I was just talking about that this morning, and we've been seeing that. Apart from Apple, which I can't really figure out, look bullish, doesn't look bearish right now, but Microsoft and a lot of the other names, AMD is done for the near term. So yeah, it's looking a little tired for sure.
It does.
Exhausted.
It does. And a lot of these sectors like XLK, if you look at them on a longer term basis, you'll see that they just don't have that much more upside momentum to go, and they're just really mimicking the QQQ. Like look at communication, which has Google and Meta in it. You'll see that it's approaching short-term top. Look at semiconductors. All of these things look like they're overbought. The problem is we're done with earnings. There's no major catalyst, and we have summer on the table. So to me, it looks like all of this is just going to be approaching this overhead resistance level and not really doing anything. Now, the most important thing is, and again, when you look at momentum, one of the things I look at with momentum is I don't just look at the number, the raw number. I look at which way it's moving. And if you look at the 50-day, here's the problem. QQQ is going straight up right now. But look at momentum levels. Let me just make it easier to read. They're coming down. They're not coming up. That's the 20-day. Same thing with the 50-day. So this is confirming, and you don't have to be an Einstein to see that very few stocks, and when I say very few stocks, I mean very few stocks, like 5% of the index. I mean, look at this. Look at
the one doing all the heavy lifting.
Yeah, they're doing all the heavy lifting. And what that is, to give you a good, for people here who are new, imagine you're watching a car go around the racetrack at 50 miles per hour. And imagine it's a 8-cylinder car. And imagine 4 of those cylinders stop working. But you don't know that because you're not sitting in the car. You're watching from a distance. Well, the driver has to push on the gas pedal twice as much. The car now has to generate twice as much torque to give you that kind of momentum. So it's going to get hot really quick. And when you have summer coming up and momentum is declining and you're at overhead levels and there's no major catalyst and most of the market is bearish, that's a problem. That is a big problem.
I feel good about my 4,200 peak on the S&P. It's holding even further, Roger. That's great. Hey, now, we're actually getting close on time here, Roger. And I know you got something coming up.
I do. I just want to show you one more thing, and this goes into regard to what Garrett was talking about. Energy, similarly, on the other hand of the coin, if you look at energies here, I just want to be very brief here. They look like they've bottomed out and they look like they're going to start coming right back up. So energy looks really good from a short term. I'm not talking about a 6-month hold, but I'm talking about swing trading. Energy is starting to look really, really good. So I'm totally in line with what Garrett was saying. And I'll say exactly what he said. Warren Buffett knows more about energy than either of us do. And he's increasing his exposure in Oxy. So before I let everybody go here, I haven't pitched anything in a long time. Pay close attention. What if there was a way to get your option half off, sometimes more than half off? What if you can buy an option, a $3 Apple option for only $1.50? Wouldn't that be great? Same strike price, same expiration, but half the price. You could simultaneously be able to increase your upside potential while at the same time you're decreasing your risk. Now, thanks to a little calendar trick that Matt, my assistant, and I have been testing out, We've unlocked a new way to trade the same option you love for half the price. In fact, we recently closed a trade on FedEx for 35% gain, risking half the cost. So it's like investing $1,000, cashing out with $1,350, cutting your risk in half, which means you don't have to have as big of gains because your risk is twice as small. Next week, I'm going to do something very cool. I want to invite you to my first ever masterclass on this calendar phenomena. I'm calling it Discount Options Unlocked. Here's what you can expect. It's going to be 2 days, 2 parts. They'll be recorded 10 a.m. each day. What this discount calendar options are, the upside to using this approach, how to select discount calendar options, best way to initiate and liquidate the trade, defending against risks. That's the first day. Second day, timing your options for the best bang for your buck, how to gauge rip high probability opportunities, using technicals to find potential targets, using seasonality to time the trades, and looking for opportunities in real time. And I'm going to show you a really cool seasonality tool that will knock your socks off. All in all, 3 to 4 hours, full hours of training value will be recorded. Plus, I'll be using the same trick on a trade alert that I'll be sharing in class. And if it's anything like the last time, well, it was a 35% risk on return on reward in a few days. All in all, I've sold these type of trainings. 2,000 would be a gross underestimation. I've sold these trainings for as much as $10,000 in the past. Today, I'm not going to run. It's not going to be that. All right. We're on the verge of a complete trading breakthrough, and I want you in at a low price. Plus, I'm going to give you 2 trade alerts in that classroom, and we're going to find them together. We're going to go hunting for trades. Not just that, I've already uploaded 13 modules of education so you can learn about options if you want to, and they have never been seen anywhere else. They're exclusive to this program only. So if you want to be an option ninja, this will help you do it. And I believe you'll be blown away by what you learn in this Discount Options Unlocked course. And it's completely risk-free. If you're not happy, it's on me, okay? I will give you every penny back, and we'll part as friends. If after 2 courses you're still not happy, just ask me for your money back. I'll give it to you. It's not going to cost you $2,000. It's not going to cost you $997. It's only going to cost $297. You're going to spend 2 days with me, and it's 100% satisfaction guarantee. Follow the link below. Go to wealthpress.com/roundtable or call 877-212-2644. I never thought I would do a class for $297, but I'm doing it. Please don't delay. If you have too many people, it's not going to be good. I want it to be hands-on, and you guys know how hands-on I am. It's a limited time offer, and we're going to shut it down very quickly. Do this now. 2 days, the 24th, 25th. It'll be recorded if you miss part of it. I'll be right here in front of my computer going through all of this in and out. Plus, once you sign up, don't close the page. You're going to get an opportunity to unlock all of the best educational packages for a big, big, big discount. And I mean a big discount. And we've never done these educational programs before. This is only available for folks who are smart enough to attend Don's midweek's roundtable. So do it now. This is a special thank you for Don for being such a nice host to us. $297. I honestly can't believe I'm even saying that. Click the link below, get started. Calendar spreads are a very fun way to lower your risk and have the opportunity to make the gains. And with our seasonality tool, you're going to absolutely love it. So follow the link, join us now, and have an amazing, amazing day. Thank you, Don, for allowing me to pitch this.
Oh, that's great, Roger. No, thank you very much. And you guys, that's a great rate, right? I mean, $297. Spreads are the way that you survive this kind of sideways action, right? This grind in and out, right? You just collect that premium, let it work for you, cut those costs on those options a ton. A lot of great information here, a lot to learn. You guys got to hop in. You got to just click one of these links. Raleigh's dropping them in there right now. So click them and join. You'd be a fool to miss it.
You really would. It's a really good deal. I mean, I've done these classes for $9,997. I'm giving you the same info for $297. It's worth it.
Well, I can just say from experience that whenever Roger teaches something, you want to be there. It's an absolute no-brainer. I've been in a classroom with him. Wow. The information that you're going to get is going to blow your mind. I guarantee, well, I don't want to guarantee, but I just feel very strongly that there is no way that they can put into those slides the amount of content that you're really going to get from Roger Scott. It is phenomenal. I'm thankful that it's going to be recorded because you're going to want to go back and listen to it over and over again, because that guy, he puts a lot of effort into when he teaches people. There's going to be so much content. Every single word he says, you're going to want to grasp. And I think it's really going to help you this summer, as we've mentioned, trading. You got to be savvy. You got to be on your toes. And I know Roger's really fantastic at helping people do that. And the other bonuses that they've got in store for you. Wow. That's phenomenal.
I guarantee you're going to get your money worth. I will guarantee you'll get your money worth.
Yeah,
So you got to join. $297. It's nothing, right? That's one call option on a small stock. So do it.
Do it, guys.
Okay, guys, this has been a great session. Thank you very much. Roger, always appreciate information. Celeste, you've been great. Love it. And guys, click the link and we will see it. Garrett had to roll. He had some deadlines coming up, but appreciate everybody being here. Appreciate everybody for turning up on the to watch this. Thank you to all the guests out there and to everybody watching. We'll see you guys next week. Thank you.
Thanks, gang. Bye, everyone.
Thanks, everyone.
Bye, Don. Bye, Celeste. Bye, Garrett.